Really do. Look, we go back throughout the past few months. The market didn't start having some issues until liquidity started coming out of the system. And frankly, the liquidity stemmed from two things. The first one being the government shutdown, okay? And if you look back throughout history, let's specifically the 2018-2019 government shutdown, there was only about a 0.3% negative hit on GDP because of the lack of liquidity and the lack of funding in the government. This time around, it's actually projected that we're going to lose about 1% of GDP because it was over 40 days. We're more reliant on the government than we were in 2018 and 2019. If you look back in history, too, with the stock market, that 1% contraction usually correlates to about 5 to 8% negative, top to bottom correction in the stock market. Where were we at just last week? The NASDAQ was 8% top to bottom. So the second part was the Federal Reserve becoming a little bit more hawkish, right? The chance of the December cut kind of became 50-50 last week. We're now like at 80%, so it's more likely now. But with December, liquidity coming back in the system, government shutdown, Federal Reserve getting a little bit more dovish now. Fed member Waller being a little bit more dovish yesterday, and then quantitative tightening ending December 1st. I think this is a really bullish setup as we head into holiday shopping season in December.
Yeah.